In this lesson, we will make an analytical report about sanctions evasion methods. Sanctions evasion is increasingly sophisticated, leveraging complex ownership structures, trade manipulation, payment obfuscation, intermediaries, and shell companies. Effective detection requires understanding these methods, recognizing red flags, and implementing robust compliance controls. The table of contents provides a structured overview of key topics related to sanctions evasion and compliance. It begins with an analysis of evasion methods, including the use of ownership structures, trade manipulation, payment obfuscation, intermediaries, and shell companies. It then explores red flags that signal potential evasion activities and concludes with compliance best practices, offering actionable strategies to detect and mitigate risks effectively. This framework ensures a comprehensive understanding of evasion techniques and equips professionals with tools to enhance sanctions compliance efforts. Let's start with the first topic about evasion via ownership structures. Sanction parties often obscure their involvement through layered ownership chains, nominee shareholder-said directors, trust arrangements, and aggregated ownership below regulatory thresholds, e.g., the OFAC 50% rule. These tactics involve creating multiple shell companies across jurisdictions, splitting ownership among proxies, and using professional intermediaries to mask control. For example, OFAC's 2025 action against GVA Capital exposed offshore structures and proxies managing assets for a designated Russian oligarch, emphasizing that actual control or benefit, not just formal ownership, can trigger sanctions liability. EU and UK authorities have similarly uncovered cases where sanctioned individuals transferred beneficial ownership to family or associates or used trusts to retain influence over assets. FATF and the Wolfsburg Group highlight frequent changes in ownership, opaque legal entities, and professional gatekeepers as key typologies. Red flags, complex multi-jurisdictional structures, frequent ownership changes, use of nominees or trusts, aggregated minority stakes, entities with little business history. In this second topic, we will talk about trade-based evasion. Trade-based evasion exploits the movement of goods and services to disguise the involvement of sanctioned parties. Techniques include over-invoicing, misstating the value of goods to move funds covertly, misrepresentation of goods, especially dual-use items, falsified shipping documents, and transshipment through third countries to mask the true origin or destination. Front companies in trade finance may provide false end-user certificates or act as nominal buyers-sellers. OFAC and BIS have penalized firms for failing to identify such schemes, with enforcement cases involving Russian and Iranian networks using Turkey, Armenia, and Uzbekistan as transshipment points. Red flags: newly formed companies placing large orders, mismatched shipping documents, goods inconsistent with business profile, reluctance to provide end-use information. In the third topic, we will talk about payment evasion techniques. Sanctions evaders use correspondent banking, nested accounts, currency substitution, cryptocurrency, hawala networks, and structuring to avoid detection. Funds are routed through multiple banks and jurisdictions, often using alternative currencies or breaking payments into smaller amounts. Smurfing. Cryptocurrencies and informal value transfer systems like hawala offer anonymity and bypass traditional controls. OFAC has sanctioned exchanges and individuals for facilitating crypto-based evasion, while FATF highlights the use of nested accounts and alternative payment channels. What about red flags? Payments routed through third countries, use of non-dollar currencies, high transfer volumes to high-risk jurisdictions, and use of unlicensed money service businesses. The fourth topic is the use of intermediaries. Intermediaries, including front persons, brokers, third country agents, and professional enablers, lawyers, and accountants, are used to distance sanctioned parties from transactions. These actors may serve as nominee directors, shareholders, or bank signatories, often in secrecy jurisdictions. Professional enablers help create and maintain shell companies, provide nominee services, and facilitate complex transactions. FATF and FinCEN have documented the central role of such intermediaries in sanctions evasion networks, including North Korea's use of shell companies in Hong Kong and Malaysia, and Russian elites leveraging art dealers and brokers. About red flags: use of nominee officers, requests to remove identifying information, involvement of professional enablers, and transactions routed through unrelated third countries. Sanctioned parties evade via layered ownership, nominees and trusts, trade fraud through falsified docs and transshipment, payment channels like crypto, hawala, and structuring, and intermediaries such as front persons and enablers. Red flags: opaque structures, mismatched shipping records, cross-border payment routing, and nominee officers. Compliance must scrutinize ownership, transaction patterns, and intermediary networks to disrupt evasion.